This is Mason, and hey, Dan, how are you doing today?
I'm great, man. Just getting ready for Japan. All kinds of new projects starting. Having fun.
Oh, yeah. It is April 1st, and Dan and I are both leaving the country for several weeks in just a few days. That'll be after this episode comes back, but it's been a challenge and fun for us to put all our own businesses in line and in place to make sure that we can leave the country for a few weeks because it is still very, very busy. And I think it's a prime time for this episode since April is tax season. And the guest that we have today is an expert in tax mitigation strategies and cost segregation.
Yeah. So I just did my first couple cost seg studies this year. It was tremendously helpful. I saved like $80,000 in taxes for the cost of $5,900. So Isaac Weinberger, and he's known as the cost seg Isaac, working and running a team at Madison Specs, and collectively they deferred $500 million in liabilities for their clients via cost segregation. And so Isaac's not just your typical tax advisor. He's a bit of a visionary in the world of real estate finance and taxation and is a seasoned cost segregation expert. I mean, we asked him some really specific, difficult questions, and he answered them very astutely. So this guy knows what he's talking about. And so he walks us through all the ins and outs of cost segregation in this show, when you can and cannot use it, times where it might be detrimental versus valuable, some legislation that's potentially coming in the pipeline that might be very beneficial. So overall, this was an awesome conversation. I'm excited to talk to Isaac.
Heck yeah, let's bring him in. The man, the myth, cost seg Isaac. How are you doing today?
I'm doing great. Thank you so much, Mason and Dan, for having me on. It's always an honor to get invited onto shows, especially this show. I know you guys only invite the good guys, so I feel very honored and I'm excited to discuss cost seg with you guys today.
Heck yeah, we're excited too, and we've got a mutual friend and connection, Ash Patel, that there's a previous relationship with Isaac, which is how we got to know each other, and I'm super excited for this show. But Isaac, for the person that hears cost segregation, which the show is going to be titled, we've got Cost Seg Isaac on it. We've spoken about it, but for the newbie who doesn't understand what cost segregation is, can you explain it at a high level, and then we'll dive into it deeply throughout the episode?
Absolutely. One of my favorite topics, but something that you did mention for a second, which I want to give 10 seconds to in tribute, but just a shout out to Ash Patel, one of my favorite friends and clients, a retail mastermind. He's taught so many people about real estate and invest beyond multifamily. There's a lot more out there besides multifamily. That doesn't mean multifamily is bad, but Ash is a great guy. Actually just had a call with his business partner today. So exciting people. In regards to cost segregation, one of my favorite topics, something I talk about all the time. Obviously, my wife is like, no, we're talking about costing in the house. But something so important for every single investor, every passive investor, every operator to know. It's not just, we'll talk about it on today's show, but it's not just about a cherry on top. Cost seg changes the dynamic of deals, and I'm excited to explain how that works. So let's rewind for a second. Cost segregation is depreciation on steroids. What does that mean? The parable I always give is I stop you on the street, Mason, and I say to you, hey, Mason, you remember like 10 years back, I borrowed $100 from you. You're like, oh yeah, heck yeah, Isaac, I remember that. Where's my money? And I say, hey, Mason, I could either pay you $10 a year for the next 10 years, or I can pay you $30 today and then $70 over the following 9 years. Or 9 months, but the idea is you're not going to get it today. I would say out of the 8 billion people in the world, 8 billion out of 8 billion would say, give me as much as possible today. Because a dollar today is worth more than a dollar tomorrow. That is the same idea of cost seg. Cost seg is that I'm coming in as a cost seg shop and I'm allowing you to take more of your depreciation earlier on. Now you may ask, hey, Isaac, what is depreciation? And believe it or not, people are like, hey, I didn't even realize that my accountant was giving me depreciation every single year. And the way it works is that even though one of the big reasons we are all in real estate is because properties go up in value, appreciation, The government views that your property is going down in value due to the fact that it's older. So a residential property has a 27.5-year lifespan. Of commercial property is a 39-year lifespan. You buy a commercial property for $1 million, you'll take that $1 million net of land. So we'll take probably 15% for land. So let's say $850. You'll depreciate that over 39 years. You'll get a little bit every year as a tax deduction. So even though the property is going up in value, you still get benefits as if it's going down in value, which is just makes real estate so much more beautiful. You get appreciation, depreciation, and everything else in between. So that depreciation will come to you over 39 years for commercial, 27.5 for residential. Cost segregation, we come in, we identify certain components that can be taken faster. We allow you to get those deductions earlier on. The idea is offset your partners, your investors' tax liabilities earlier on. Use that extra cash that you have in your pocket, and go invest into more real estate. Make that money work for you, those extra deductions that you have. That is the gist of cost seg. And obviously there's so many details and nuances, which I'm assuming we'll get into. But like I call it, I coined the phrase, depreciation on steroids. That's the way it works.
Yeah, I love that. And I like what she said. Well, there's quite a few points, but specifically that dollar today is worth far more than down the road. And this is more true than ever with what our government's done to our money supply these last few years. And so I just did my first couple cost segs on two small buildings I have, and I was able to write off like $205,000, saving myself over $80-some thousand net in taxes this year for a total cost of, I think it was $2,800 or $2,900 per. So $5,800 or $5,900, whatever. So no, it's an excellent method for those that know how to multiply their money today. So Isaac, who does this not apply to? Is there a scenario where I go and do a cost seg and I can't use it against my income?
Absolutely. And that's an unbelievable question. And the answer is as follows. Somebody who's not getting hit with taxes, so then very nice, I could come into your property and unlock tremendous savings. But if you have nothing to use it against, then it's worthless, right? So many times, actually, real estate syndicators, they themselves are not getting hit with taxes. They refi, they take money out against the property. But a lot of times their partners are, their investors are, et cetera. I'll give you a perfect example, okay? So I have a client. They live in Pennsylvania. She is, the wife is a doctor or nurse, and the husband is a real estate professional. He does cost seg on his properties, and he files jointly with his wife, and he can offset his wife's doctor income, which is incredible. She's making $300,000, $400,000, $500,000, $1 million a year. Offset that income, save yourself a lot of money. If you guys are totally real estate guys, not involved in any other side hustles, you're not making any other side income, then you could look at it this way. What about your investors? You have an investor that's investing with you. They invest with a lot of syndicators. They have a lot of passive income. They're making $300,000 a year in passive income. Let me go ahead and get depreciation benefits and offset my passive income. Sometimes LP investors are real estate professionals, believe it or not. You could have somebody that's a dentist, their wife is not working, their spouse is not working. You can make them into a real estate professional. Obviously, you have to contact your local orthodox CPA and make sure that he's okay with that. But long story short, if you can get that done, you can offset your spouse's income. So again, there's so many different avenues. And something I tell people all the time is that it's not so complicated, but it sounds complicated, but at least pick up the phone and call somebody. We spend so much time on making money, on making the next buck. Maybe spend half that amount of time on saving that buck that you work so hard to bring in. So yes, if you're not getting hit with taxes, if you, your partners, your investors, nobody's getting hit with taxes, you're not going to benefit from it. If you do a gut renovation on a property, you're not going to get too much benefit in that property. It probably will not make sense to do a cost seg. It will make sense to do a cost seg on the renovation budget. You spent $300,000 on the renovation, but in terms of the purchase, probably not. So there are scenarios. Or if you sell the property within a year, because then you get hit with something called depreciation recapture, which means that the same tax liability that I got out of will come back to me. It's like a 1031. You could defer your capital gain so long that you keep exchanging. The second that you exchange and a second that you sell the property and you don't exchange, you will not get hit. You will get hit with those capital gains. So obviously there are scenarios, where it will not benefit you. But something I post all the time on LinkedIn, be open to learning, because believe it or not, you might not be gaining from it. Maybe your investor can. And by you not meeting the depreciation actually could be a plus to give over portions of your depreciation to your investor and make him excited to come in on the deal. So definitely a lot of nuances.
Absolutely. And so for those listening, just to summarize clearly, beyond just not making money that you need to shelter, ideally, if you're not a real estate professional. So an easy example would be if I am a full-time doctor and then I try and buy a bunch of rental properties and do a cost segregation study, I'm not going to be able to offset that. Again, it's just me. I'm the doctor. I'm not married. I'm not going to be able to offset my income from my W-2 job as a doctor with the depreciation. Am I right there, Isaac? And can you just define real estate professional?
Absolutely. So great point. And this is something I talk to folks all the time about. So real estate professional status gives you the right to offset ordinary income. So believe it or not, if you're a real estate professional, if your full-time profession is real estate, and then let's say on the side, you do some Amazon and you're making a few $100,000, you could actually go ahead and offset that Amazon income. But like you said so beautifully, let's say somebody's a doctor and he's making $1 million a year, and then he invests passively with syndicators like you guys, Mason and Dan. And he's getting his K1, he's getting his proceeds, he's getting all his stuff. And can he go ahead and you offer him $100,000 in losses? Can he use that against his doctor income? And the answer is no, because he's not a real estate professional. So those depreciation benefits will not help him. What people do, and that's what I alluded to earlier, is really structuring properly with their spouse. If their spouse is not working, hey, get their spouse on the deals, get her involved, work 750 hours a year in real estate, maybe even get their spouse a job in a real estate company as an acquisitions analyst, just to, as if prove enough to the IRS that you're somewhat involved in real estate activities. Once she has, or he has that status as a real estate professional, you could file jointly and use that against your doctor, dentist, lawyer, CPA, any income. So yes, there are many scenarios where the investor will not benefit. But keep in mind, even if you're not a real estate professional, you could always offset passive income. So somebody who's investing $50, $100, $150,000 a year in real estate syndications, eventually it will domino effect and will be getting a nice amount of passive income every year that you can offset. I have a client who just signed with me a few days ago. He's not a real estate professional. He bought a $500,000 office building. He's going to get an $80,000 deduction. He is not a real estate professional, but he has $80,000 of passive income. Offsetting that $80,000 of passive income will save him around $25,000. That's a no-brainer, right? We're not talking huge money, some money.
That's fantastic. And Isaac, one clarifying question. Is there a maximum amount for the scenario where you have a spouse that's the real estate professional and then the other spouse is or you're the doctor making $1 million a year? How much can you reduce your tax exposure through a cost seg study and the bonus depreciation on that?
That's a great point. I do believe, I'm 99.9% sure that there's no limit in terms if you're a real estate professional. Now, that's if you're a real estate professional. There's something called the STR loophole. I actually posted about this on LinkedIn today, where even if you're a W-2 guy, so let's say take Isaac. I'm the sucker that's getting people huge tax deductions and I'm paying taxes, right? I plan on buying an STR this year. Why? Because if you buy an STR, you can offset W-2 income if you manage it a specific amount of hours. It's a debate how many hours. It could be 100, it could be 500. But the point is, you can use that to offset your W-2 income. On that, there's a limit, I believe, of $500,000. So even if I would buy a $100 million portfolio of STRs, I wouldn't be able to offset unconditionally. There would be a limit of $500,000. I believe when it comes to reps, and that's why, I don't know if you guys remember that Donald Trump put out a few years ago that he paid $750 in taxes. Everybody was up in arms. And the question I had was, Donald, why do you even pay $750? You should have paid nothing. Now, we all know that Donald Trump is a billionaire, right? He says he's worth $20 billion. We all know that he's not worth $20 billion, but at least he's worth a few billion. And I think it's unlimited. I believe so. It's something I'll check into deeper, but I believe that it's unlimited when you have real estate professional status.
That's awesome. And even for the person that doesn't have it, you're able to, or in that scenario where there's that $500,000 max, you're able to carry that loss over to the next year and then offset your future income by that
Absolutely. Well said. Well said. It doesn't go bad, and it just carry over losses, and just have those in your bank account that you could just wipe away your taxes.
Perfect. So within the world of cost seg studies and depreciation, obviously there's so many different asset types or asset classes that you're able to get depreciation on. I've depreciated my truck in my business. Dan got a decent write-off on some of his single-family rentals. Within your world, has there been a particular asset class that you're able to get a higher amount? Like, for instance, within commercial real estate or restaurants or car dealerships or office buildings versus multifamily, is there one particular asset class that stands above the rest?
Love this question. And this is something that every single person has to know, because so many people are so obsessed with multifamily. And obviously we got the retail guys. There's certain asset classes that everybody runs after: retail, strip malls, multifamily. Then you take the mobile home parks of the world, mobile home park guys of the world. You take hotel guys and all that stuff. The deductions that you could get in mobile home parks and hotels are tremendous, much, much greater than multifamily retail strip centers. And we all know that nobody's going to buy a deal just for depreciation purposes alone. You're comfortable with multifamily, you're comfortable with retail, you're not going to jump there for those purposes. But believe it or not, there's people that reach out to me like, hey, I need a lot of losses. I'm willing to go into another asset class for the sake of depreciation, as so long as the deal pencils. Mobile home parks are the number one go-to. And the way it works is that when we come into that property, much of the property is structural components, which we cannot go ahead and give you year one. So we're trying to take out everything that's non-structural. We come to that property, there's carpet, there's flooring, there's cabinetry, chandeliers, windows, we take that out. Give that to you as early as possible. Mobile home parks, the way it's structured and the way the government, I guess, established it, is that, hey, it's not really structural. Hence the fact that they're movable and stuff like that. They're not really so embedded in the ground and stuff like that, foundations and stuff. So you could take a lot of that year one. I did a mobile home park for a client, a $5.8 million acquisition. We got $4 million back year one. I don't know the percentages on that, but that's probably like 80-something%. So that's incredible. Hotels with the FF&E, which is all the furniture and stuff like that, the deductions are incredible. Again, multifamily is great. You get garden-style multifamilies with pools and tennis courts and pickleball courts. You'll get a lot of stuff. Even retail strip centers. If you have a big parking lot, we'll get parking lots consider land improvements, which is an aspect of the components that we could take using a cost seg. Huge deductions. So no two properties are created equal. I could have two different industrial properties. One will get 30%, one will get 7%. It really depends. But in terms of what the best asset class is, mobile home parks. We won't talk about car washes. We'll talk about it. Car washes and gas stations are the best. You get like 100% of the purchase price, net of land. But the reason why I don't want to talk about car washes and gas stations was because that's more of a business, as opposed to mobile home parks and everything else is really real estate. Hotels is also a business. But in terms of real estate, mobile home parks are the best. In terms of businesses as well, obviously you got to buy the real estate too, is car washes, gas stations, and hotels.
That's fantastic. Two questions on that. First, with mobile home parks, I see a lot of times where people will own the land and own the pad site, but not actually own the home. Can you speak a little bit towards that whenever you're getting a cost seg study done, and just from the investor point of view? And then second to that, could you spend a little bit of time kind of differentiating between structural and non-structural parts of the building, just so whenever someone is maybe looking at a deal, whenever they're walking through, they can say, okay, I can depreciate all this stuff, but I don't even need to think about that in terms of doing a cost seg study. That's going to be more of a straight line depreciation that's included in the building.
Absolutely. And I'm happy you brought that up. I actually probably should have differentiated between park-owned homes and tenant-owned homes myself. So a client came to me with two properties, two mobile home parks. One of them we got like in the projection 70%. One of them we got like 40%. And he's like, hey, Isaac, just curious, great numbers, but what happened? Why is there such a big discrepancy? And I asked him, I guess I forgot to ask him earlier, I said, hey, I think my team had looked into it, but me, myself, I had not. Long story short, one of them had a lot of tenant-owned homes. One of them had a lot of park-owned homes. If they're park-owned homes, so you own these homes, so we can depreciate all those homes. If they're tenant-owned homes, all you own is the land. In this situation, the reason why he still got 40% of the purchase price, because there was a house, like a front office house, which we were able to go ahead and depreciate a lot of that, and we were able to work it out for him. But the point of the matter is, if they're tenant-owned homes, you get less because you don't own them. If they're park-owned homes, you get more. So that's a big, big difference. Sometimes if you see why you get more for this and less for this, and they both look like the same style parks. That's first of all. In terms of structural versus non-structural stuff, you come into a multifamily property, starting to do due diligence on your multifamily property. You come in, you check in the units, you're walking the units, and boom, you see chandeliers, you see flooring, you see cabinetry. All those stuff are all 5-year components, which means components that you can that can be taken year one. The reason why I say 5 is because, like I said earlier, structural components get depreciated over 27 and a half years for residential and 39 for commercial. 15-year components, which is land improvements, get depreciated over 15 years. 5-year components are chandeliers, flooring, cabinetry. That gets depreciated over 5 years. Now, when we talk about bonus allows you to take most of 5 and 15 year on year one. But in terms of structural, non-structural, all these items that are going to go bad over a quick period of time, that's considered non-structural. When you come to a building, I know, let's say my in-laws live in Passaic. In Passaic, a lot of these houses were built in Passaic, New Jersey. A lot of these houses were built in the 1800s or early 1900s. Now, the houses usually don't go bad. Obviously, over a period of time, they go bad, but it takes them a very long time, the bricks and the actual foundation, to actually really deteriorate. As opposed to cabinetry, flooring, windows, light bulbs, chandeliers, they all get bad over a period of 5 years. Those types of items can be taken faster, as opposed to structural items, which is really the base and the foundation and the walls, that's depreciated over the longest track.
Sure. That all makes sense. So something we've touched on a few times but haven't defined is bonus depreciation. So can you speak to what that is, what the scenario has been since Trump was in office, how that has slowly reduced what we could take each year, and then the potential for 100% bonus depreciation to come back, and whether or not you think that's going to happen?
Absolutely. People see me in the street and are like, hey, Isaac, in 2027, when bonus depreciations get going to completely phase out, unless Congress brings it back, who are you going to work for? Are you going to work for Mason? You're going to work for Dan? Are you going to become I don't know, sell vacuum cleaners to multifamily operators? So they're like, you're going to be out of a job. And I'm like, you guys have it completely wrong. And this really answers your question. Prior to bonus depreciation being implemented in 2017, September of 2017, cost seg was still a multi-billion-dollar industry. And let me explain how. I told you guys earlier that cost seg is depreciation on steroids. We talked about 3 different buckets: the 27.5 and 39-year bucket, which is structural, the 15-year bucket, and then the 5-year bucket. Prior to bonus depreciation ever being implemented, we were able to accelerate, doing a cost seg study, we could accelerate components from 27.5 and 39 years to 5 and 15 years. So it could be 20%, 30%, 40%. Now, you won't be able to take that on year one. You weren't able to take that on year one, but you were able to take a lot of that over the course of 5 and 15 years, which gives you a higher depreciation amounts in the first 5 to 15 years, as opposed to evenly dividing it over 27.5 or 39 years. So prior to bonus depreciation ever being implemented, there was a huge benefit on any property purchased over $2-3 million to do cost seg. So even if bonus depreciation completely phases out, yes, it will knock away the smaller purchases, and yes, the syndicators will not be able to offer their investors as much depreciation, but it still will be well worth it. That is something just to clear the air. So thank God, and God willing, we'll still be in business even if bonus completely phases out. Now, in 2017, Trump instituted something called bonus depreciation. He implemented this bonus depreciation idea, which means all the 5 and 15-year components that we identify can be taken on year one. So let me give you an actual case study. We come into a property that you purchased for $1 million, okay? Take away land. Land never goes bad. It's going to be here in 7,000 years. You're left with $850, 15%. By the way, land will vary based upon the city that you're in. If you're on the beach in Miami, it'll be more. Well, let's say just standard 15%. We identify 20% of the 850 as components that can be taken over 5 and 15 years. 20% of 850, I believe, is 170, something like that. So we could go ahead and 170 can be taken over 5 and 15 years. In 2017, Trump implemented that all 5 and 15-year components can be taken on year one. Not only can you allocate and divide that evenly over 5 and 15 years, you can take that on year one. So you will get a $170,000 deduction year one as opposed to approximately a $30,000 deduction in regular depreciation, which is incredible. That went through September of 2017, 2018, 2019, 2020, 2021, 2022. December 31st, 2022 was the last day for 100% bonus depreciation. If you close the property December 31st, 2022, for $1 million, you can get approximately 170 to 220, 250, depending how much we find year one. If you close the same exact property one day later on January 1st, 2023, you only can get 80% of that 100% that we found. So we found 170, you could get 80% of the 170 year one. The remaining money will come to you in years 2, 3, 4, 5, and it won't go bad. It'll still be there. You won't be able to take that in year one. In 2024, it went down to 60% bonus, which means we find 170, you take 60% of that 100% of that 170 that we found. In 2025, it will be 40. 2026 will be 20. 2027 will be 0. Okay? Happens to be that there is legislation right now going through Congress to bring back 100% bonus depreciation, which means that if we find 170, you'll get all 170 year one. A big misconception many people make is they think that they only can get that amount of bonus depreciation if they do it in that calendar year. So say you bought a property in 2022 and you did not do a cost seg on it yet, right? And you decide today, we're holding today April Fool's Day, right? April 1st. You come to me and say, hey, Isaac, I want to do a cost seg on that property, but I know I'm only going to get 60% bonus, but I still want to do it. It makes sense. Hey, you're not going to get 60%. You're going to get 100% bonus. The way it works is it's based and it's all dependent on when you put that property into service. So if you place it into service in 2022, you'll get 100% bonus. If you buy property in 2022 and do the cost seg in 2048, 20-something years from now, you'll still get 100% bonus. So just to summarize for a second, then I'll hand it over to you guys. To summarize, bonus depreciation is cost seg on steroids. So cost seg is depreciation on steroids. Bonus depreciation is cost seg on steroids. But even if bonus depreciation phases out, cost seg will still be very, very relevant and very beneficial due to the fact that you could accelerate items to the 5 and 15-year budget.
That was perfect. And I think if you have no familiar with just general accounting principles, go back and re-listen to that a handful of times over, and then also just look up depreciation, because I think back to grad school and taking accounting classes, and whenever you are looking at a building, you can, just like Isaac is saying, you can lump them into these buckets that you're going to be able to depreciate at 5 years, 15 years, 29 and a half years, or 27 and a half years, and 39 years, depending on the asset class. And I think that something important to recognize is that even if you have not been using bonus depreciation, which you should through cost segregation studies, you should still need a cost segregation study to be completed, because the only reason you wouldn't have that done is because your accountant is lazy or doesn't know what they're doing. And so they're going to choose straight line depreciation because it's so much easier for them to do whenever they're doing your tax returns every year and you're creating a pro forma on a document. I remember creating pro formas for new builds, and we would do straight line depreciation because it was way easier, because it's really, it's theoretically a lot of work to be able to add all of that stuff up. So I think that's really important. And then another point that I just want to drive home, I've got a building that we bought back in 2022. It's a nightmare rehab story that you guys are familiar with if you listen to the podcast regularly. I don't really care that it's taking so long because I'm going to be able to get a cost seg study done whenever it's all completed, and I get 100% bonus depreciation on that once we complete the cost seg study. So just wanted to make a couple additional points if you might have gotten lost there for a second, but I highly encourage you to rewind that and listen to that a few times over if you're investing in single family or any form of real estate at all. But Dan, to you with a question.
Yeah, I had a couple comments too. Everyone in Congress owns a lot of real estate, so I have a feeling that'll get pushed through, and political affiliations will suddenly go out the window when it comes to each individual saving themselves money. So number two, I think of the bonus depreciation having just made this more mainstream, where if that were not a factor, it probably wouldn't have made sense for me to do it on the 2 buildings I did. And if you didn't have, like you said, $2, $3, $4 million plus buildings, it didn't make as much sense. Whereas now with the 100% bonus and 80% on the second one I did, it made sense even on a medium-sized duplex and a big house. So anyways, Isaac, all that to say, a couple more clarifying questions here. So let me use that as an example. I just did those 2 cost segregation studies, and we talked about the recapture, right? Where if I were to sell them tomorrow, my basis, and correct me if I'm wrong, my basis would be lowered by the amount that I took in accelerated depreciation, which would increase my capital gain tax on those buildings. Now, what's the scenario if I hold these for another 20 years and then I sell them? Well, the carpet has actually worn out. Like that literal depreciation has happened. Many of those components, the 15-year and 5-year, have actually worn out. So would I get to keep the benefits of that depreciation because those timeframes have passed if I wait 20 years to sell these?
It's an unbelievable question, and I want to give you guys a compliment because I get on a lot of podcasts and people ask that question, really know what you're talking about. So it's impressive. So kudos to you and you guys, to all the listeners. You guys have some good hosts that ask some good questions. They don't ask me the easy questions. Ask me the hard questions. I'm going to get to that in a second, Dan. Great point. Something I just want to echo that Mason had said. Something I tell all my guys, and I get into trouble for it a little bit because I've got feedback from CPAs. They're like, hey, don't diss us. If you're in real estate and you don't have a real estate savvy CPA, you're leaving money on the table and you're not being smart. So if you're in real estate, it's not just about cost seg. It could be 1031s. It could be DSTs. It could be so many different things that you just need that real estate savvy CPA who knows how to maneuver and play your cards right. So Mason, very, very well said. In terms of Dan's question, it's one of the sore topics of cost segregation for me. And the reason is as follows. To me, and any guy that has any sort of half a brain, if I live out the depreciation of that specific item, why do I have to pay back recapture? If I lived out the life for 15 years of this parking lot, even if I go ahead and sell it, why should I pay back? Unfortunately, the laws do dictate that the second you sell it, you get hit back with recapture. Maybe that's one day we could change that, but unfortunately, you do get hit back with recapture even if you hold on to it for 20 years. That being the case, I just want to fill everybody in. It could be you guys know this. Maybe the listeners don't. If you 1031 the property when you sell it, not only do you get to defer your capital gains, you get to defer, and I think you mentioned this, you get to defer your tax liability as well, your depreciation recapture. Many people don't know this. They think, hey, if I exchange it, I'll just be able to get rid of my capital gains. If you did a cost seg on one property and then you sold it, but you exchanged it to another property, you'll be able to go ahead and throw that loss into that new property. And like you said, it'll bring down the basis of the new property. And depending on what the new basis is, that will dictate whether or not you can do a new cost seg on the new property. Because if you sold it for $1 million and you bought a property for $5 million, very nice, you did a cost seg on the original one, but there's enough of a basis to do another cost seg. As opposed to if you sold it for $1 million, you bought a new property for $1 million, $1.1 million, there's going to be a smaller basis. And I get it. Could be it's still possible, but that's something that you should know. But yeah, directing back to your question specifically, unfortunately, you will get hit back with recapture. But the idea is, it's something that everybody should know, is even if you're not going to 1031 it, time value money. If I met you in the street and said, hey, Pay me 4, 5, 6, 3, whatever it is, depending on the situation, $1,000 to do a cost seg study. You'll have the ability to kick the bucket down the road for 2 years. Think about what you could do with all that extra cash in your pocket for those couple of years. Obviously, the bigger the purchase, the bigger the write-off. The bigger the write-off, the more money in your pocket. You have extra $100,000 burning a hole in your pocket, you'll be able to make a lot more than $5,000 of that $100,000 over the next 2 years than you would have without that $100,000.
Yeah, I'm glad I asked that. I had a CPA tell me something different. This person was not an expert in cost segregation, so I'm certain that you're right, and they were not. But I'm glad we asked that. That's interesting, and that I guess I'm not surprised, considering it's the IRS, that reality means nothing.
Absolutely. So important. So important for all of us.
Perfect. Well, a quick question, and then I have another follow-up question to that one. So a lot of us have the idea of whenever we buy a primary residence, it's eventually going to turn into a rental property. So say I bought a house in 2020 as my individual residence or primary residence, and then I move out, let's call it this year in 2024, and I keep it as a rental. How would you go about doing a cost seg study? Would you recommend not doing it? Or if you came into this situation, what would you do?
Absolutely. So just to get it clear, you bought a property as a primary residence and you turned it into a rental.
Correct.
Do those properties all the time. It's a great case of doing a cost seg study. Obviously, there's no recapture or anything. You turned it from primary into a rental. You're good to go. Actually, sorry. The reason why I talked about recapture is I'll just preempt it by saying if you had an investment property, you did a cost seg on, and then you turn the investment property into a primary, you don't get hit with recapture. So you're good to go. Your situation is the opposite. You have a primary, you want to turn it into a investment property, you're good to go. We can do a cost seg. There's no difference. And actually, it works perfectly fine.
Perfect. And just a piece of advice for those out there that's why if you get a good deal on your primary residence and it's going to make a good rental, keep it forever, because as soon as you move out, instead of getting, you might get that cash back of the equity that you have in it, or you can keep it as a potentially cash flowing rental and get to take that bonus depreciation, especially if you bought it back when rates were great. And it's just a huge opportunity to write off a ton of stuff, especially if you leave all your furniture in the house too whenever you move out. So things to think about.
Absolutely, yeah. Done a lot of things. So it's definitely very, very beneficial.
Agreed. One of the ones I did this year was once a primary for me. So Isaac, one more specific question we've alluded to a couple times, but I wanted to clarify. So one of my partners on a couple buy and holds, he's a doctor, full-time W-2. And he probably does also work full-time in real estate, but the IRS will never go for it. So for all intents and purposes, he cannot take depreciation and write it off against his W-2. Now, in our partnership, is it possible to make an agreement where I take all or most of the depreciation from the buildings we own 50-50 partners together without changing the 50-50 ownership?
It's a great question. So there is something called special allocation, special depreciation allocation. You are complicating it a bit in terms of not changing the 50-50 partnership. Basically, what Dan is asking is very, very great question. Hey, I don't want to change the partnership agreement. I want 50, he wants 50. For the promote, whatever it could be, and why should we change it up? I want more depreciation. It's possible. It's something that you have to speak to your CPA or your attorney. Every single deal is different. Sometimes it's the attorney, sometimes it's your CPA. It's really in the OA, an operating agreement. You could actually specially allocate certain amounts of depreciation. In this situation, your partner is not really benefiting from it so much, so why not use it? I've helped people do this all the time. It's not something that we actually do, but we'll help direct them and speak to their CPAs and their attorneys how to do that. But it's definitely possible. I was on a call last week with a client trying to help him out do this. It's not so simple. You have to do it before you go under contract. It's not so simple, but it can be done. A story that I actually want to pat myself on the back about is that I had a client that was under contract in a deal, a nice multifamily deal, and he was having a hard time getting the last remaining equity. And he reached out to me. It's something I try to do. I try to provide value. I have a network. And he's like, hey, Isaac, do you know anybody? And I said, hey, did you think about giving away portions of your depreciation? So instead of getting, this guy's going to invest 100 grand, he's going to get 70,000 in depreciation. You'll give portions of yours to entice him to push him over the top. We structured it properly. He got it done. We got the investor for $300K. So that's definitely possible to do specially allocated depreciation. It's not something that, again, I could sign off on, but it's possible to be done. You got to speak to your attorney and your CPA and get it done that way.
Okay, that's helpful because it's kind of funny. You really emphasized how important it is to talk to your accountant and your CPA and attorney to make sure you do it legally, because the person that I heard this from on a podcast years ago is now in jail, so he probably didn't do it correctly. So anyways, make sure your legal professionals are actually professional and are advising.
No, that's great. So, and realize, Dan and I aren't giving you any advice. Isaac's not giving you any advice right now. We're just telling you what works in our business. And we absolutely recommend you consult with your CPA and your attorney and reach out to Isaac whenever you're ready to get those cost seg studies done. But Isaac, just a note on your actual business that you're running. Where are most of your clients coming from? Are they coming from referrals from certain clients or from clients that you already have? And whenever those clients come in, are they typically accountants or investors?
Great question. My clients are owners and CPAs. So some CPAs send me a tremendous amount of work, and I appreciate them tremendously. And then owners. I have relationships with some investment sales brokers. I have relationships with a lot of investment sales brokers. Some of them have sent me business, some of them not. Some of them implemented in their deal when they put out their deal. They'll write, hey, you can get X amount of depreciation. And in terms of where it came from, so I have a fascinating journey. I started out cold calling hundreds of people a day, and it never went anywhere. Everybody talks about it works. I got a few big clients, and I gave up. Giving up is really the wrong word. I don't give up. I really pivoted, and I was like, I started doing LinkedIn, and I really started creating a brand, and thanks to God, it really took off. And when somebody goes ahead and asks for a cost seg guy on LinkedIn, thank God I get tagged multiple times. And I've been on LinkedIn for a few years. I spend a lot of time on there. I take it offline like this. So a lot of my real value relationships came from there. But again, I'm going to a hotel conference in a few days, and everything brewed and started from LinkedIn. And I have a lot of clients, some people that purchase $30, $40 million hotels. And LinkedIn's a tremendous platform if used right. Don't get bogged down by all the garbage. Look at the guys that you want to be inspired by. Look at the guys you want to follow. Try to add value. By adding value, that's where people will be like, hey, Isaac is a good guy to know. I want to go ahead and get to know better and work with him. Even if that doesn't mean that I'm going to give you work, because I'm not an investor, but when somebody goes ahead and says, hey, I need a cost seg guy, that guy tags you. So just try to provide value, meaningful comments, and thank God. It's been a journey, and I haven't looked back.
That's fantastic. And on that note, Isaac, I think that's one thing that speaks to who you are and what you're doing, but what is it that makes you different than everyone else that's doing cost seg out there or just in business?
I appreciate that question, and it's something that I really hold dear to my heart. There's a lot of great firms out there. I will never put down another cost seg firm. And by the way, some of them, I have what to say. Some of them are great. Great shops, great guys. I'm friends with a lot of my competitors. Something that I believe in myself, and I think my clients and my network know, is that I'm devoted each and every person in my network and every one of my clients. I tell all my clients, I'm not going to promise you equity. I'm not going to promise you this. I'm not going to promise you anything. But I will promise you one thing. I promise you that I will try. I have my WhatsApp real estate chats and my equity chats that I'll push the ROMs on. If I can make an introduction, so like I'll give you my I think the amount of joy that I got from the following, which I'm about to say, was more more of a feeling, I guess, the most joyful filled moment that I had in my career, more than even closing my biggest deal, was I had a client that lived in Baltimore, and I hooked him up with another guy, and they closed a nice syndication together. And that joy that brought me, like, it really brought me a lot of joy. I linked it together, and they closed a nice size deal. And just by people connecting, capital connecting, and just being of value has given me a name in the industry as somebody that it's worth it to know and do work with. So yeah, again, there's a lot of great firms out there, but in terms of the work that we provide is top notch, definitely top tier work. But on top of it, just being a guy that provides value to my clients, I believe, is something that really takes the cake.
That's fantastic, and how everyone should be approaching their personal brand that they're creating and their business that they're creating. But Isaac, as we move towards the end of the show, are there any questions that we did not ask you that you wish we had?
We definitely covered a lot, I have to say. Dad and Mason, you guys did a great job. Something I think I would just add, there's a huge misconception out there is about look-back studies. People think that, hey, and we talked about this a little before, hey, I didn't do a study in 2016 or 2017. I can't do it anymore. 50% of the work that we do are studies that, like, the client bought it in 2018. He was taking regular straight line depreciation, and we could actually go back and retroactively get you huge amounts of depreciation. So that's a big misconception. But I think we covered the ins and outs. You guys did a fabulous job. You guys are great hosts.
That's awesome. We appreciate the praise, even though we did not pay you to say any nice words about us.
They did not. And guys listening, they did not.
There it is. And the look back study is a fantastic thing to ask, whether it's your cost seg expert or cost seg Isaac here, and just your CPA. A good CPA, whenever you sign up to work with them, is going to go back and look at your taxes for the last few years and make sure everything looks good. But Isaac, where can people find more out about you?
I tell people all the time, you'll faster get a response on LinkedIn at a LinkedIn DM than you'll get on a text. But obviously my phone number, my email address, but LinkedIn, Isaac Weinberger, Cost Seg Isaac on LinkedIn. That's where you can find me every single day. And I look forward to talking to you all.
Isaac Weinberger on LinkedIn. This is Dan Abercost and Mason McDonald for the Big Picture Blueprint, signing off.